tax loss harvesting. I feel like not that many people know about it, but yeah, this can have big implications when it comes to actually investing. So if you have a taxable investing account, so just like any type of stock brokerage account, and let's say you buy something that actually loses money. You put $100 in, it's now worth $80, and you have that $20 loss, right? We can actually sell that stock and realize that loss and have it offset our gains in that year. So in this case, that $20 loss, that could offset a $20 gain. I think a lot of people don't realize this. They invest some money, they lose some value, they get scared of investing. But the great thing is that the IRS actually allows you to use that loss to reduce your other gains. Now, sorry in advance, but just to get a little bit more technical about this, losses will first offset your gains. And then if your losses actually exceed the gains of that year, you can deduct up to $3,000 against your ordinary income. And then the rest you can actually carry forward indefinitely. Let's say, God forbid, you lose $1 million in a year investing. Now you'll be able to use that $1 million loss to offset gains for as many years as you want. Now, there are a bunch of rules to this. So if you want to do this, I definitely recommend looking into it more. This is just like a broad overview, but I feel like this is a rule that not that many people know about. And it can actually take people that are scared of investing and losing money and give them like a, oh, okay, I can actually use those losses to offset any other gains. Like, that's pretty cool. The next money lesson I want to talk about is spending pre-tax money versus post-tax money. There is a huge difference. And I really wish I understood this in my 20s. So the other day I was talking to a friend who has a W-2 job. He makes a lot of money. His salary is like $300,000 per year, but he was telling us about how big his paychecks were every 2 weeks. And the amount just blew my mind. Because yeah, you'd expect, let's say $25,000 per month. Well, actually, after all the deductions and 401k and taxes, he's making about $12,000. So about half. Now, I want you guys to understand this because this is why I am so bullish about business. This is why I think everyone that wants to become a business owner should become a business owner. The reason is because when you have a business, you're earning 1099 income. This is different than W-2 income. It's very powerful because we can actually take deductions against this income and get our effective net income closer to zero. As a W-2 employee, there are so many deductions you cannot take. For example, if I only have a W-2 job and I buy a laptop, I can't write that laptop off from my income. I can only write that laptop off if I'm making 1099 income. Of course, it gets a little bit more complicated, but I truly believe that 1099 income is the best income to make. If you guys start a service-based business and you're, let's say, doing photo shoots for clients, then you're earning 1099 income. If you're acting as a freelance consultant, you're also making 1099 income. If you're doing side hustles or gigs and stuff like that, you're making 1099 income. So at a 50% effective tax rate, which is what high earners pay here in California, so basically spending $100 in my business is the same as me spending about $50 of post-tax W-2 money. It's a really interesting concept that I encourage you guys to learn more about. But once you learn it, it's going to really encourage you to go down the entrepreneur route.